Hello, everybody. Welcome back to another episode of our podcast, Loans, Liens, and Listings. I'm Michael Romano with Contour Mortgage.
John Enriquez, Exit Family Realty.
Rhonda Klch, President, Equity First.
Well, welcome, Rhonda.
Thank you so much for having me today.
No problem. Thank you for coming.
I love it. I love your studio. This is great energy.
Appreciate it. We try. It's how we do things at Contour Mortgage.
I love it.
So why don't you tell everybody, what is it that you do?
So I am the founder of Equity First. So since 2004, we specialize in helping small businesses and consumers that are in financial distress. So our primary purpose is to work with centers of influence, like the two of you, where clients may come to you with a credit or financial challenge. We are actually the problem solvers, right? So you've identified the client, but now what? So you have a client with a bad credit, can't get them a mortgage, or somebody's looking to sell a home or do something with a home and maybe they're in foreclosure and then you're stuck. Well, we're the problem solvers. We're the people that take it from there and hopefully, fill your pipeline in a few months from now.
Awesome. So is credit usually the biggest pitfall that you run into?
Most of the people that we work with, and again, we predominantly, I say centers of influence, so attorneys, accountants, financial planners, bankers, mortgage professionals. Right. So most of the time, it will be credit related. Somebody wants to buy a home or refinance, and the credit gets run, there's collections, there might be liens, lack of credit, new credit users. So there's something there that we'll say is an identifier. And your primary focus is how can I take the client from point A to point B when you're stuck with a 573 FICO. So again, I have over 25 years experience in the credit industry. Oh, wow. So I can take a look at somebody's credit report and say, hey, it's no big deal, we're going to do this. So sometimes it's looking at a credit report and adding new positive credit, adding trade lines. It might be paying off collections, having items deleted. There's a whole myriad of things that we look at to figure out what the appropriate strategy would be for the client. And then of course, it's also about timing and setting the appropriate expectation. So if you have a client that's already in contract and then you find out that there's a credit issue, well, I know it's more of a 911. I may have to take some shortcuts just to make sure that we can fulfill the obligation of their commitment time and approval time for the loan. Right. So we may have to get something done in a shorter period of time, more like 30 days versus 60 or 90.
Gotcha.
What's like one thing that you always see that always weighs down credit, predominantly like the biggest factor that holds it down the most, or what's something that really is like just terrible for people's credit, like when you're looking at the situation?
Yeah, so there's a few things, right? So you have the people that actually have a lot of credit and they've never made a late payment. Super annoying. I mean, you look at credit all day. You run a credit report, somebody has a 560 credit score, and you're staring at this report going, I don't get it, there's no late payments. How does this person have such low credit? Right. Chances are they're overutilized. High utilization is a big thing, especially this time of year, because people just got done using their credit cards for the holidays. Mm-hmm. So if you are overutilized, meaning you are literally maxed out on your credit cards, your score is going to tank. So there's a couple of quick fixes. So somebody may not have 10 grand to pay down their credit card debt. So we have what's known as an authorized user or AU accounts where we can add temporary trade lines. It offsets the algorithms. Adding that money in offshoots the overall utilization, and within a matter of a few weeks, we can take a 560 and bring it to almost a 700.
Wow. Just through authorized users?
Just through authorized users, yeah.
Really? That fast?
The other thing that we see right now is a lot of people that were in either loan with their mortgage moratoriums or they were in student loan forbearance programs, and they did not take the appropriate steps to get themselves back into a program. So we're seeing a decent amount of that as well.
Okay. Now, let's say there's different types of borrowers. Let's say somebody has 30 credit cards with a $1,000 limit versus someone with 2 credit cards and maybe there's a $10,000 limit on each one. Does that make a difference when analyzing their credit, or is it kind of like how just they repay back their limit?
Yeah, so the factors that they're going to look at is, again, it goes based to the utilization. So even people will say to me, well, it was only $100, because they may have a $10,000 credit card or a $100 credit card, It's all relevant, and it all goes according to the way that it gets reviewed and the way that it gets scored. So if you have a late payment on a $100 line of credit or a late payment on a $10,000 line of credit, it actually will impact it exactly the same.
Got it.
Now, what is the utilization rate that you keep mentioning? So I've heard a couple different things. Usually I hear the 30% mark. Is that accurate? If you're at 10% versus 20%, does that increase your score, or is it just below 30%, you're in good shape?
It's generally anything below 30% is good, but
Okay.
obviously if there's nothing else going on the credit at all, bringing it down to under 10% will then kick it generally up again.
Gotcha.
And sometimes it's the length of the credit history. So think about people that are new at utilizing credit. Sometimes their scores are predictive of the fact that they have not had credit history long enough. And then that goes back to the authorized user. So if you pick up an authorized user account that might be open for 5, 6, or 7 years, that aggregate gets added in. So instead of your credit history being 8 months old, now they get to readjust the numbers, and it lands up that it's now 3 years old. That will help increase the credit scores as well.
Interesting. Now, what is a FICO score made up of?
So it's a combination of the length of your credit history.
Okay.
It's also going to be the way that you repay back your credit, how much credit is available. Those are really the biggest factors. And then, of course,
Gotcha.
the way that you repay it back. So if you do everything the right way, your credit scores will be higher.
Of course.
And we get clients that'll say, I want a higher score, or how come this isn't happening? It also is in constant change. So don't get yourself upset. You know, somebody that has very similar types of spending habits to yourself may have a higher score or a lower score, because there's always little predictors in between. Also, how many accounts you have. So if you have an installment loan and 2 or 3 credit cards, you should be good. Right? That's really all we recommend, you know. And don't close anything just because you're not using it.
Right.
People will call me and be like, great news, I just closed 8 credit cards. Yeah, but those 8 credit cards were open for the last 10 years, giving you, again, when they're analyzing the length of credit time, and now you've shortened it because your most recent card, you know, which is the only one you left open, is now a year old.
Right.
You've got, you know, you've closed out those cards, so it's now shortening your length of time that you have access to the credit.
Yeah. I know a lot of people, I mean, I'm sure they ask you, but sometimes even showing property, some people will ask like, oh, I don't want to pull my credit. It's a hard inquiry, it's a soft inquiry, and they don't know the difference. Like if it's TransUnion, Experian, Equifax, how is it judged? So can you just elaborate a little bit on how, like, why is it like, how does Equifax different from TransUnion? Which one's more important? Or
So the 3 major credit bureaus, as we know, are Experian, Equifax, and TransUnion. So the reason why people will have different scores, for example, is because not every creditor, number one, reports to every single bureau. It is a pay service. Sometimes people say, oh, I thought the credit union, you know, the credit agencies were maybe a governmental agency. They're not. They are for-profit organizations. And you have to pay to subscribe to report, which sounds crazy. You're actually paying to report somebody else's data.
Wow.
Right? So if you have different credit companies, they may not all necessarily report at the same time, and they are all supposed to report the same way. There's a system called eOscar, which is the main hub, right, that everybody's data gets reported to. But generally speaking, the scores are going to vary a little bit based upon the way that it's being reported, as well as is every single creditor reporting exactly the same across all 3. So if you ever notice, if you're running a credit report on your side, somebody's TransUnion might be really low, but it might be because there's a collection for T-Mobile and they're only reporting to TransUnion. So the other 2 scores are high and the one with the collection is low. So there's usually some sort of a variant that goes in between, which is why that they're, you know, a little bit different, but they all work off of the FICO model. Whereas in what we get a lot of times is people saying to me, I have a great credit score with Credit Karma.
Yeah, I hear that all the time.
Right, but credit, and then all of a sudden they think they have a 700 because Credit Karma is 700, and then they go to you and they're like, hey, you know, what happened? You're pulling a 635, and it's because Credit Karma works off of the Vantage scoring system. So there's different models in the credit industry, whereas in the mortgage industry it relies on the FICO system. Credit Karma works off the Vantage. For somebody like myself in the credit industry, we work off of the data. So we're not necessarily driven by score. All I care about is the data through all of these companies the same? And the answer is yes. They are all purchasing data from the same place. So whether it be Credit Karma or looking at a credit report that you supplied to me, the data will be the same.
And what advice would you have for, like, let's say a first-time home buyer that they're thinking about maybe buying, or they have like a 1 or 2 year window that they want to prep themselves, besides saving money to like help their credit get to like the highest level possible? What are some tips or strategies you would give like a first-time home buyer? So if they have
any debt, and their credit is good, I would say look for a credit card that would be a balance transfer to a 0%, because that will help you actually pay your debt down faster. Make additional payments if you can. So even if the minimum payment was $25, logging in even an extra $10 a week, making extra payments, again, offsets the way that the algorithms run. If you are maxed out but you have good credit and you know that you're going to max yourself out, call the credit card company, ask them for a credit line increase. That will keep your utilization ratio lower, even if you need to use the credit card. And don't make any crazy purchases. And you guys should know that, right? There's nothing worse than pulling somebody's credit. And the next thing you know, you're like, oh my God. And they pull up in their new BMW at $635 payment. So again, it's always important that people be aware and very cognitive of their spending habits, the way that they're making their payments, and essentially learning how to budget. Which is a lot of what we do as well for clients. You know, it's not just credit related, but a lot of what we do is budgeting as well, especially for first-time home buyers.
Oh, that's great.
I have a question.
From the gentleman in the back. Yeah, go ahead.
We can reiterate some of this with one of you guys too, but one of the things I hear all the time is, when you're paying off your credit card, right? Run stuff on the credit card and then pay it off at the end of the month. Is it okay if I run up and pay in the middle of the month, like the middle of the week? Doesn't matter?
So I'll make it real simple. It doesn't matter, because every credit card company, like every credit card you have in your wallet right now, has a different due date. So Capital One might be due on the 1st, and your GM card might be due on the 7th, and your Bank of America card might be due on the 11th. So just if you get your statement and you make the payment, again, all that really matters is that you're making your payment on time.
Okay, so now I'll give you a perfect example, right? Obviously, everybody's doing electronic payments now, right? So I'm going to my bank app and everything, and I see, okay, well, there's a bunch of stuff going on my credit card. Let me just pay it off now. Should I wait until the statement gets released, or
no? Not necessarily.
If I buy something today and then tomorrow I pay it, it's still not going to make much of a difference as far as my.
No, it'll keep your utilization down, because what happens is if your credit gets pulled in the middle of you having a reporting cycle, that debt might be there. So what you might be thinking about is, how does the debt look at that time during that month? So if you have somebody who uses, for example, American Express, they probably make their payment once a month. So if they make their payment on the 17th, but you pulled it on the 14th, chances are whatever they owed in that lump sum will be reported, and it's going to look like they have more debt than they currently do. So again, everybody's payment cycles are different. So there's no real answer as far as to when to pay. Just make sure you pay.
Okay, so just to sum that up, the last thing here. So if you know you're about to have Mike run your credit to do that, whatever payment you're going to make it before he runs that payment.
I would say make it before, and you need to give yourself at least 3 or 4 days for it to update and cycle. Because even if you make the payment, I call it real time. You can make the payment in real time, but they don't report in real time to the credit reporting agencies. Remember, there's a manual input that needs to happen, right? So the systems all have to be connected. So you paying today doesn't mean that tomorrow if you pull the report,
next week,
it might be a week out before doing so.
Someone's selling their house, purchasing another house.
Yep.
When they close on their mortgage, on the sale, and the mortgage comes off their credit report, how bad is that going to affect their credit? Like, because I know if you close a credit card, it could damage your credit by, I don't know, 20 points, let's just say. Closing a mortgage, how bad does that, do you have any idea? Like
so it's not, so first of all, it will show up as paid.
Okay.
Assuming that they were paying.
Right, that's important.
Let's start with the fact that we assume
That's
that
important.
they sold their home and they have now satisfied their mortgage.
Yes.
And it now shows that there is a zero balance. It potentially, what we will see on occasion is potentially a small decrease, which people go nuts about, but you've now closed an active trade line.
Right.
Right? We see it with cars too. I had a phone call today from a client and he said, I just paid off my car, but my credit went down 6 points. It makes no sense. And what's happening is you've actually closed an active trade line.
Right.
And if you don't have other lines of credit to back it up, you've closed something that was relevant to helping you maintain and establish the credit.
Gotcha. Okay. So but the decrease shouldn't be 30,
Nothing
40 points or
substantial.
something like
No,
that.
absolutely
That
not.
could screw up their next purchase.
No,
Okay.
No, you should be fine.
Awesome.
And the last question I had too is paying something off early, like a car or a mortgage, could that, because a lot of people think that's gonna, like you said, it's gonna boost their credit. Is it always it'll negatively impact them because they're trading their line, or?
No, it's not that it'll always negatively impact. It's a matter of, do they have other lines of credit? So if you have somebody that only has a car loan, and that's all they have because they use debit cards for everything else, they just don't have enough established credit. So if that was to be the scenario and we knew in advance, I would recommend for somebody to open up a credit card so they could just start establishing more appropriate credit. So when the time comes that they pay their car off, because they don't want to carry that debt, because they want to qualify for a mortgage and it might affect their debt to income ratio. You know, they think they're making smart choices, but if they close that out without having other credit lined up, it could actually just be prohibitive for maybe how much credit they're extended in the future.
Awesome.
Cool.
All right. Well, thank you so much for coming and
You're
visit.
welcome.
It was
I
a
could do this
pleasure.
all day.
I appreciate it. It was very informative.
Yeah.
Thank you so much
Thank
for coming.
you. Thanks for having me.
No problem. All right, guys. I
So
hope you
if you-
all enjoyed everything. Hope you learned a lot. Again, I'm Michael Romano, Contour Mortgage.
John Enriquez, Exit Family Realty.
And Rhonda Klch with Equity First.
See you soon.